Hello and welcome to this latest episode of Damien's Market Update, which is the show where I talk about what's been going on in investment markets and what to look out for in the days and weeks ahead. As ever, if you enjoy this show, please make sure you hit that like button on YouTube, but also subscribe to the channel. And if you're listening to this as a podcast, then make sure you give us a 5-star review. Any questions you have, just make sure you stick them below this video and I will answer them. So with the intro out of the way, despite last month's surge, global stock markets concluded August in the red. Now initially the stock market decline at the start of August exhibited characteristics of healthy sector rotation into defensive stocks, but it eventually gave way to broader market weakness, with all sectors including defensive slipping into negative territory. So what was behind this stock market weakness during August? Now, at the outset, the 10-year US Treasury yield hovered just below 4%. That's at the beginning of August, but it eventually surged to 4.3%, which coincided with the stock market low point on the 21st of August. And consequently, the tech-heavy Nasdaq 100 experienced nearly a 7% dip at its August trough. So it's a positive correlation that re-emerged between the Nasdaq 100 and the 10-year US Treasury price. Now, the catalyst behind the uptick in US Treasury yields, the rally in the dollar and the stock market downturn, was renewed concern that US interest rates might need to remain elevated for an extended period of time. Now, this apprehension stemmed from the release of strong economic data throughout August, and in a similar vein, official UK data indicated that while inflation was receding, it was stubbornly high. Now that prompted market expectations of additional rate hikes from the Bank of England. In a minute you'll see how that has subsequently changed as we go into September, but I'll leave that for now. But as August drew to a close, attention turned to the Jackson Hole Symposium, which is where global central bankers convene, often sharing insights about inflation and future monetary policy. Now, if you recall, last year the stock market unravelled following the hawkish comments by Fed Chair Jerome Powell at that event. Now, this year, investors hope to avoid a repeat performance. Now, somewhat regrettably for investors, Powell once again delivered a hawkish tone at this year's symposium, initially causing markets to price in at least one more interest rate hike by the Fed in the current year. However, a slew of economic data during the last week of August hinted at the potential emergence of a new Goldilocks scenario in the US. Now, this data suggested that despite elevated interest rates, the US consumer was faring well and the US economy might steer clear of both a recession and overheating. Now, this perceived Goldilocks scenario, where everything appeared just right, where the Fed could potentially avoid further rate hikes despite Powell's earlier hawkish comments, was in contrast to the market narrative in earlier August, and it fueled the late August global rally in equities. So as we've moved into and through September, investors have clung to this Goldilocks narrative in the US, and it means that any new economic data releases have become crucial in supporting or quashing this narrative, while any central bank surprises have the potential to ignite some more volatility. Now, early in September, US Treasury yields rose again and equity markets slumped as strong US services sector data raised concerns of overheating, spurring rate hike fears once again. Now, there was an element of deja vu when you compare that to the start of August, but higher oil prices driven by supply cuts from Russia and Saudi Arabia didn't help by adding to inflation worries and increasing pressure on central banks, and it led to the US dollar rallying towards its 2023 high. But on a positive note for UK investors, at least, a weakening pound after dovish Bank of England comments about the fact that the base rate might be near its peak versus the US dollar that was strengthening boosted overseas investments. That's because of that currency kicker that you can get. Now, elsewhere, China's economic recovery showed some promise following interventions from the Chinese authorities to prop up its economy, but a ban on iPhones for government workers led to a 6% drop in Apple's share price in a single day. And as the adage says, as goes Apple, so goes the market, which meant that the tech giant weighed on the S&P 500 during those couple of days. But one of the focal points of September was always going to be the monetary policy decisions from key central banks. Now, last week, the European Central Bank, the ECB, surprised the market with a 0.25% interest rate hike, causing the euro to drop. However, the ECB statement that came alongside that suggested a peak in monetary tightening, leading to positive reactions in European equity and bond markets. So attention now turns to the US Federal Reserve, the Fed, and the Bank of England this week. So the Bank of England's Governor Andrew Bailey had recently remarked about falling inflation, had already shifted markets' expectations for base rate hikes. In fact, the market is now predicting there will be just one more 0.25% increase in the base rate this week. So we'll have to see whether that happens. But with Andrew Bailey's comments that inflation would continue to fall into the year end, and with the ECB suggesting there could be a pause in rate hikes, the question is now, what will the Fed do? The market already anticipates no more rate hikes or few rate hikes from the ECB and possibly the Bank of England. Will the Fed follow suit in its September policy meeting this week? Now, the market expects one more rate hike from the Fed at the moment, but we'll have to wait and see what happens. Any surprises could cause wobbles in markets. So that means there's been a lot going on since the last show, but it all means that so far September has followed the typical historical pattern of proving a challenge for investors. But the market is starting to believe that major central banks are concluding their rate hiking cycles earlier than expected. If you remember, for example, in the UK, it was predicted that the Bank of England would take the base rate to 6.5% in the spring of 2024. That's a big change from what they're predicting now. So if it's the case that we are nearing the end of this rate hiking cycle, it could mean there'd be a significant change in the performance of different asset classes, because they do change during the interest rate cycle. As anybody who takes out an 80/20 investor membership will know, I've done a whole research piece on how different assets perform during different parts of the interest rate cycle, from hikes to pauses to when they inevitably start cutting rates again. So you can take out a free trial if you do want to see that piece of research. So the message is to keep an eye out for any changes in the behaviour of investment markets and particular assets. But for all the headlines and market narratives which chop and change, it can pay to keep things simple. So I would suggest keeping an eye on the strength of the US dollar and in turn bond yields. In particular, a rally in either has usually led to stock market weakness over recent months, and so if we see a fall in the dollar, for example, that could prove a tailwind for certain asset classes. So that is it for this episode of Damien's Market Update. I did cover a lot there. Any questions that you have, do put them below this video and I will answer them for you. If you enjoyed it, then do hit that like button, but also subscribe to the channel so you can get the future updates of this show.